Well, here to talk to us about England's second wave of liquidity is Simon Hayes, the Chief UK Economist at Barclays Capital. Mr. Hayes, thank you for joining us this morning. If I can just begin by asking you about this idea of buying more bonds, do you think that it's likely to happen today, or likely to happen in the short term?
I don't think it will happen today, and I don't expect that it will happen at all. My expectation is that, in fact, the next move in policy is likely to be a tightening, although not for some time yet. Even so, the committee's clearly positioned itself to increase QE purchases if the need arises, and I'd say there's probably a 1 in 3 chance that does happen over the next 6 months or so. But I think we're going to need to see some weaker data before that actually comes to pass.
Let's have a look at inflation, because you're actually suggesting that it would be better to have a target band of inflation rather than a point that the Bank of England had to get to. What's your thinking behind that?
Well, at the moment, the Bank of England's inflation remit is specified in terms of the point target of 2%. Now, monetary policy isn't that accurate a tool. In some ways, it's unreasonable to expect a central bank to deliver a point target. But more importantly than that, I think there are times when the rate of inflation that's appropriate in the economy changes, and we're in that situation at the moment. Inflation's running above 3%. Now, the Bank of England, if it was strictly targeting 2% inflation, could have tightened monetary policy last year to deliver 2% inflation this year. I don't think most people would think that would have been a sensible move. But what we have now is a rather uncomfortable situation where the Bank of England is essentially turning a blind eye to above target inflation, and that can be damaging to its credibility. People know it has a 2% target, but they can see that it's not hitting that target. If, on the other hand, we had a target range and the Bank of England were able to say that, given the current economic circumstances, inflation remaining around about 3% for the next year or so seemed appropriate, then it would take some of the pressure off the Bank of England, I think, and make its life a little bit easier. But
might not that just be seen as an easy way out? I mean, just changing the goalposts, if you like, so that they don't actually have to bring inflation down?
I think that is an important point. Whenever you think about changing these sorts of regimes, you have to think about it very carefully and do it very carefully. I don't think that it's something that should be done straight away. Now's not the time to be changing any of the goalposts. But as we come through this crisis, it's important that we do learn some lessons about the robustness of the various macroeconomic structures that we have in place, and I think, thinking about what the appropriate specification of the inflation target is something that, at a future point, we do need to revisit.
Simon Hayes, Chief UK Economist at Barclays Capital, thank you very much indeed.